The JSE has reached a record high. At the end of trade, the index was 1.4% higher at 85,960 points. That's as China's central bank has announced a stimulus package, and the U.S. Federal Reserve took everyone by surprise and cut interest rates by 50 basis points last week. Both moves have lifted markets. The improvement in a global sentiment has also given the rand a boost. The local currency is hovering at a level last seen in February 2023. Prosus has fully cut its stake in Chinese online travel agency company Trip.com. That's according to a Bloomberg report. This has been done through a 12.8 billion rand block trade. The move marks Prosus's final exit from the company after it had been gradually selling shares over the past few months. The firm has declined to comment on the matter. Growthpoints offloaded its stake in Capital and Regional. The disposal of that 69% holding forms part of a broader transaction and relates to New River REIT's planned takeover of Capital and Regional, which will see Growthpoint receive nearly £51 million in cash and over 67 million New River shares. Growthpoint CEO Norbert Sassy says the group still believes CNR is an attractive platform with a high-quality portfolio of assets and strong prospects, but it's become non-core to its strategic focus. Growthpoint will use the cash proceeds to strengthen its current balance sheet and to pursue investment opportunities. Gemfields has flagged lower half-year profits. The precious stones producer says its shareholding in Sedibelo Resources has now been written down to zero. And that, along with lower revenues, higher operating and financing costs have weighed on its bottom line. Gemfields expects to post a 23% decline in profit after tax to just over 255 million rand. The firm set to open its books on Friday. Take-home pay in South Africa is on track to beat inflation for the first time since 2020. That's after 5 consecutive months of improvement. According to BankServe Africa's tracker, average nominal take-home pay rose by 6.7% year-on-year in August. That improvement in purchasing power is expected to provide much-needed relief to cash-strapped households and provide support for consumer spending. And further afield, powerful trade unions and executives at Volkswagen have kicked off pay talks that are likely to determine how aggressively Europe's biggest automaker pursues layoffs and potential factory closures in Germany. Let's take a look.
Trade unions and Volkswagen company executives kick off landmark pay talks. It's likely to decide how aggressively Europe's biggest automaker pursues layoffs and possible factory closures in Germany. Tensions are running high as VW has threatened to close plants in the country for the first time. That's put it at odds with the key IG Metall union, which has vowed to fight any such moves. The union must also negotiate new labour deals for the core VW brand's 130,000 workers in Germany. Earlier this month, the automaker ended agreements that had safeguarded employment at 6 of its plants there since the mid-90s. VW argues high energy and labour costs in Germany make it harder to compete with European peers. It's also warned Chinese rivals want to grab a big chunk of the region's electric vehicle market. The VW brand's personnel chief said the division must cut costs to stay competitive. He called the firm's situation serious and said labour and management must work together on restructuring. Other German automakers feel the pain too. BMW and Mercedes-Benz both cut their profit forecasts in recent weeks due to weak demand in China.
Sticking with labour issues abroad, according to the union representing thousands of striking Boeing US factory workers, its members are overwhelmingly against the plane maker's latest pay proposal, which the company has described as best and final. Here's more detail in this report.
Striking workers at Boeing aren't interested in a new pay deal made by the company. That's according to the union representing them, which said it had done a poll to find out. The International Association of Machinists and Aerospace Workers said the offer of a 30% pay hike was overwhelmingly rejected. Instead, it's seeking a 40% jump and the restoration of other benefits. More than 32,000 Boeing workers walked off the job earlier this month in the union's first strike since 2008. That has halted output of the firm's best-selling 737 MAX jets, threatening billions in costs. Boeing didn't comment on the rejection of the pay proposal, which it had described as its best and final offer. The firm had extended a deadline for a vote on the new contract, after previously setting a Friday cut-off. It's all just the latest twist in a tumultuous year for Boeing, which began with a mid-air blowout on one of its MAX planes. That revived concern over the company's quality controls and hurt its ability to ramp up output of the jets. Now it's frozen hiring and furloughed thousands of workers in response to the strike in a bid to contain costs. A Ryanair boss Michael O'Leary, a huge buyer of Boeing jets, said the firm had told him there would be delays delivering new aircraft. The Irish airline chief said he was told the delays would be the length of the strike, plus 2 or 3 weeks on top.